Well, we have a pretty remarkable day for the labor market. Uh, for the first time in my memory, there are more jobs available than there are unemployed people in this country. It seems like a pretty great milestone. Hey, isn't that wonderful? There's so few people unemployed that the companies want to hire more folks than there are, left in the labor market by a pretty big number. 1.34 million, let's just round down 1.3 million more jobs available than there are people who need jobs. That sounds great, doesn't it? Well, not so fast, because you have to remember the number of unemployed people are does not count long-term unemployed folks. These are just, I guess you call them the recently unemployed. I forget when it is that you drop off of the official labor market and you become not in the labor force. You're long-term unemployed, which is no longer counted as unemployed. And I used to cite that as a reason for why, the fact that we had such a low unemployment rate for so long, down in like the threes, was not really something to be that happy about, because the labor participation rate since 2008, it dropped. A bunch of people fell out of the labor market after the 2008 crisis who got fired or laid off from their jobs and never went back, never got another job. That having a low unemployment rate just didn't mean that much, because in absolute terms, there were less people working. But now when I see numbers like this, and I say, well, gee, all these folks who have been long-term unemployed, for over 10 years now, 13 years ago, all these folks who dropped out of the labor force, they can come back if they want to. This is the strongest labor market, and I mean strongest for if you're a job seeker. You've got more options now than ever that I can recall. People everywhere in every industry are just begging for employees. And so if any of those folks who fell out of the labor market after 2008 were ever to be coaxed back into the labor market, if they were ever to find a new hope of finding work, it would be now, I would think. Because it's never been the economy's never been the same since all those people fell out. It's not natural. It's not like they just all of a sudden at once everyone decided to retire at the same time. It doesn't work that way. There was something that fundamentally broke in the labor market after 2008 that pushed labor participation down from its old range in, I think, the upper 60s to now the low 60s. I think it's hovered around like 62% or something for this entire business cycle. So I'll be curious if there is any sort of a spike in the labor force participation rate coming up, because if there was any chance of these people ever getting back in, like I said, now would be the time for them. So if that doesn't happen, if we don't see labor participation pick up significantly, like a few percentage points, I don't know what to say at that point. I guess that those folks really are never coming back. And when you have less people working in the economy is producing less. Those folks are productive. It's not just about people being gainfully employed for the sake of saying, hey, I have a job. It's about what the economy overall is putting out. And the U.S. never recovered, in terms of the trend of economic growth in this country. We never regained that trend. We fell down permanently lower, just like with labor force participation. There is less. The U.S. economy has not been firing on all cylinders for a very long time. And I wonder if, considering this imbalance now that we have between available jobs and job seekers, are we in a position where we're going to have another breakdown as a result of the lockdowns from last year? Will this be seen as a new pivot point for the U.S. economy? Are we going to break down from the post-2008 trend? Are we going to break down and start an even newer, lower trend? And unfortunately, since I'm thinking of this, off the top of my head, I'm not using notes or anything. There's figures that I would like to know that I can't look up right now, because everything I've discussed so far was not really what I intended to talk about today. What I found most interesting before I started really thinking, out loud about this, about these numbers, is that if there's truly this great demand for labor that is not being filled, and in fact cannot be filled, there are simply not enough people in the labor market to fill all of these jobs. That means really two things. I mean, it could mean either of these things, but I think in reality it'll mean both. One, automation, because businesses simply, in absolute terms, cannot get enough people to fill all these roles. Certain jobs will have to be automated, but that's a slow process. That's not something that can be done overnight, unless we're talking about a fast food place, which relatively quickly they could just go to all kiosks and have no one else taking orders anymore. You never see that again. They just all have kiosks like Wawa. That sort of thing, there you can automate away some jobs pretty quickly. But other stuff, the tools, the machines, they have to be developed in order to automate away a job. But for now, businesses still need those workers. And the only way they're going to coax folks, if they can't get them into apply now, is you keep seeing these sign-on bonuses. And the sign-on bonuses keep going up and up. First it was $100, a sign-on bonus, then it was $500. Now people were seeing $1,000 sign-on bonuses. It's not working. If the sign-on bonus keeps having to go up, it's not working. And so they're going to have to start significantly raising wages in order to coax people back into the labor market. And we're seeing this, I think, even in states like Florida that have gotten rid of the supplementary unemployment benefits, that extra $300 a week from the federal government that people were getting, they're not getting that here anymore. Yet businesses here, everyone I talk to, they still can't find work or are workers. There's plenty of work to be done, but there's very few people willing to do it. And I don't want to make the wrong impression that I'm saying that rising wages are the cause of inflation. They're not, but they are, they are one of the transmission mechanisms of inflation. Rising wages, in and of themselves, are not the source of inflation. They are a symptom associated with inflation, and they lead to other kinds of inflation. So, for example, when labor costs rise, the costs of services are going to go up. And the same is true, with anything that has any sort of the labor factor. If the labor factor of production is increasing in terms of cost, then the overall cost of whatever product it is going to rise. And that is a form of consumer price inflation. And so what I'm getting at here is that if these labor numbers are any indication, inflation is not on its way down. This bout of inflation is, as of yet, if it's transitory, technically inflation is always transitory because it always comes to an end eventually. Even if, it comes to an end because the currency collapses, which I don't think will happen in this case. But, in that sense, it's always some transitory phenomenon. But if it's transitory, it's not going away anytime soon. The more people abstain from participating in work, the less willing people are to work. The more expensive labor is going to become. It's becoming relatively, more scarce. And so even if wages don't rise and people, we just have less people working, if wages stay where they are and less people continue to opt to just remain unemployed, well, then the goods that they would have produced are going to be relatively more scarce because there's less stuff being produced, and therefore the price of the remaining stuff is going to go up. The laws of supply and demand are going to make manifest, whether that is in the form of higher wages in which case we are producing, let's say, the same quantity of goods at a higher cost, or we are producing the same quantity of goods or a lower quality of goods at at the same cost. Either way, those goods will become more scarce, because if you have if you have a budget of, let's say, $100, or let's make it smaller. Let's say you have $10, and that used to buy you 20 oranges. And now, because there's a scarcity of labor, and they physically can't find enough people to pick all the oranges, there are less oranges in the market, and so now your $100 is only able to buy you 10 oranges. Even if they're able to coax more people into coming out into the fields to pick oranges, out into the groves, I should say, and they're able to increase the supply of oranges, well, because the labor costs have gone up, because labor is relatively more scarce, they're not going to produce as many oranges as they had before. Back when, let's say they were paying folks $10 an hour, and they had to raise their hourly wage to $15 an hour. Now they might be able to pick all the oranges in the grove and get them all to market, but it's going to, the price is going to go up. Sure, you may be able to, it may be better. Had to pause there. Where the hell was I? I guess it was somewhere in that terrible orange analogy I was making. Anyway, after the labor market readjusts to the new reality, your $10 might only get you 15 oranges. So yeah, it's better than when there was a complete supply-demand imbalance in the labor market, and there was only enough labor to pick half as many oranges, and it was costing you 20, or you were only able to buy 10 oranges for $10 rather than the 20 that you did before. After labor prices rise to attract more labor into the market, it's still not going to go back to that $20 to that 20 oranges that you were able to buy before. So there's really, when you have a situation like this, there is no way out of rising prices. So that's all I have to say for today.